Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson.
Immaterial asset purchases. Immaterial asset purchases are transactions that involve buying intangible assets that do not have a physical form, such as patents, trademarks, goodwill, or software. These assets can provide long-term benefits for the buyer, such as increased brand recognition, customer loyalty, or competitive advantage. However, they also pose some challenges for accounting and valuation, as they are often difficult to measure and amortize. Immaterial asset purchases require careful analysis and due diligence to ensure that the buyer pays a fair price and does not overstate the value of the acquired assets on their balance sheet. Immaterial assets, also known as intangible assets, are valuable resources that lack physical substance. Examples of immaterial assets include intellectual property, trademarks, copyrights, patents, brand recognition, customer lists, software, and goodwill. When a business acquires or purchases immaterial assets, it is necessary to account for them properly in accordance with accounting principles. In this article, we will explore the accounting treatment and considerations for immaterial asset purchases. Accounting treatment. Identification and recognition. The first step in accounting for immaterial asset purchases is to identify and determine the assets that are being acquired. This involves assessing the nature and legal rights associated with the assets. Once identified, the assets are recognized as intangible assets on the balance sheet. Cost allocation. The cost of acquiring immaterial assets needs to be allocated appropriately. This typically includes the purchase price, legal fees, and any other direct costs associated with acquiring and preparing the asset for use. The total cost is allocated to the specific immaterial asset or assets acquired. Valuation. The valuation of immaterial assets is a critical step in accounting for their purchase. The valuation process involves estimating the fair value of the assets based on factors such as market value, income potential, or comparable transactions. If the assets are acquired as part of a business combination, additional rules and guidelines may apply for their valuation. Amortization. Amortization is the process of systematically allocating the cost of an intangible asset over its useful life. Unlike tangible assets, which are typically depreciated, intangible assets are amortized. The amortization period is determined by assessing the estimated useful life of the asset. Amortization expense is recognized on the income statement over the asset's useful life. Considerations. Useful life. The determination of an immaterial asset's useful life is important for calculating the amortization expense. The useful life should reflect the period over which the asset is expected to contribute to the business's revenue-generating activities. It is typically based on factors such as legal protection, expected technological changes, market conditions, and obsolescence risks. Impairment. Intangible assets are subject to impairment testing. If there are indicators that the asset's carrying value may not be recoverable, an impairment test is performed. If the carrying value exceeds the recoverable amount, the asset's value is reduced, and an impairment loss is recognized on the income statement. Disclosure. Proper disclosure of immaterial assets is important to provide transparency and inform stakeholders about the value and importance of these assets. Financial statements should include detailed information about the nature, valuation, and useful life of the immaterial assets, as well as any significant changes or impairment losses. Research and development costs. It's important to distinguish between research and development costs and the costs associated with acquiring immaterial assets. Research costs, which are expenses incurred in the process of discovering new knowledge, are typically expensed as incurred. Development costs, on the other hand, may be capitalized as intangible assets if certain criteria are met. Conclusion. Accounting for immaterial asset purchases involves proper identification, valuation, cost allocation, and amortization. These assets contribute to a business's value and competitive advantage, and their correct recognition and treatment in financial statements are essential for accurate reporting. Following accounting principles and providing transparent disclosure ensures that stakeholders have a clear understanding of the value and significance of immaterial assets to the business.